Welcome to Your Money Momentum, a podcast delivering information on personal financial planning, investing, and wealth management. Hosted by global wealth advisors Tom Kennedy and Kevin M. Curley II, this show will feature market discussions, strategy, and practical advice aimed at building momentum with your money. Learn more and subscribe today at gwadvisors.net/podcast. And now, here are certified financial planner professionals, Tom and Kevin.
All right. Welcome, everyone. You are listening to Your Money Momentum podcast. My name is Tom Kennedy. It is August. This is our month-end podcast, and I have the absolute pleasure of being here with Kevin today. Kevin,
so
what's
kind.
going on?
Too kind, really. Oh, just enjoying some summer. It's about 115 on average in Dallas and Houston every day, so good luck to all of us to survive, right?
I know everyone says this, but this is the hottest summer that I've experienced in the 12 years I've been here, without a doubt.
So it's the hottest summer since 2011, and we have been
I got here in 2011.
1 degree short of the record high, like several days in a row.
Right. Good. So now I have some stats to back it up.
There's some true ones. I have a local weatherman likes to tweet, so it lets us know all these fun facts. Well, let's go through the rundown, Tom.
Bringing you a look at the past month and what may come, here's the latest financial update.
How did markets do this month? I saw equity markets up again. S&P, the big large cap, now pretty leaning heavily growth, as up 3%. Small cap up 5.5%. Europe a little lower, not lower, but lower returns, up about 3%. Emerging markets really picking up about 6.25%. Pretty broadly positive for stocks. What's up with July? Just a good time for the thermostats and stocks?
Yeah, I think it was a good month. It's been a good start to the year. July was the 5th month winning streak for the S&P 500. So that's the 38th time there's been a 5-month winning streak since 1928. It went on to make 6 months, 29 of those 37 times. So we'll see if August this month can be the 30th time in history for a 6-month winning streak on the S&P 500. And by the way, those 29 times that the S&P had a 5-month winning streak, July happened to be the 5th month for those times. And all 4 of those times we finished positive between now and the end of the year. So although seasonality is against us, August and September are the 2 worst months typically for the S&P 500. If history is any indication, we might have a strong finish between now and the end of the year.
Yeah, the other key things I saw happening in markets, for at least the equity markets, it's a little change in who's leading. Energy 7.5% up for the month. Communication services up 7%. And the kind of the ones that were really rallying before, consumer discretionary and information technology, only up 2.5%. So we could have a little changing of the guard, which is a sign of a healthy market. And then as far as style, growth and value about even, small actually over large, which is a good thing to see. Quality outperforming momentum and minimum volatility. Dividends still a good game to follow along to. So any takeaways sector or style wise?
No, I think, the Magnificent Seven that you saw lead this market throughout the year.
I got a bone to pick you on that one. I hope you bring this up.
It's, I mean, look at Apple. Apple just was a 1 trillion market cap company. And then as of the last week, it just lost, I think, 250 billion, bringing it down to under $1 trillion again. So you're seeing a lot of the big winners year to date starting to give up some steam. A lot of the heavy tech names are starting to pull back, and it's your typical rotation. Like you said, you're starting to see money go into the cyclicals and the defensive names, healthcare, financials, energy. They're starting to make a little bit of a rebound because they've been lagging, and you're starting to see the equally weighted S&P 500 RSP starting to have a reversion back to the mean, because you had a very, very wide delta between the S&P 500 and then the equally weighted S&P 500. So yeah, I think it's normal and natural.
38. That's wild.
Yeah.
But to your point about the Magnificent Seven, yeah, we all know NVIDIA and Meta are off to the races, more than doubling this year, which is great. But who had semiconductors and cruises as the top two kind of subsectors? I mean, Carnival and Royal Caribbean up over 100%. Even Norwegian Cruise Line up about 50% year to date. I mean, that's that's
Well,
surprising.
I'll tell you who didn't. Hedge funds. Hedge funds on a year-to-date basis have lost, or estimated to have lost, $6 billion. I just read this in Bloomberg. $6 billion on betting against carnivals. I mean,
Well, we talked about that last year. All the debt they were going to have to refinance that they took out during COVID just to survive as companies was all going to have to be refinanced this year. And meanwhile, their stocks are doubling in value. The bet that they laid out made sense. The results don't.
You have the smartest people, or supposed to be the smartest people in the world, all begging against it, and it goes the opposite direction. So I think this year so far has surprised a lot.
Yeah, and I think semiconductors, we've talked about Dow theory before of the old Dow theory is transports and industrials both making new highs, confirmation of a bull market. The new Dow theory is throwing in semiconductors instead of transport, saying the modern economy doesn't run on rails, it runs on electrons. And semiconductors doing great, really strong leading indicator.
Yeah, well, I'll tell you, we've had just the Goldilocks scenario. I mean, every data report that's come out in the last month or 2 months, inflation coming down for the most part, both super core and headline. You've had growth, GDP picking up, but not too much, because we don't want jobs picking up. We want jobs going the other way, which they're starting to. You have wage inflation starting to come down. So we've had everything hit to put this market where it's at, which is kind of scary, because if anything goes wrong, you could see a quick 5 to 10, maybe even more % correction with any negative news. I mean, this market is priced. I mean, the forward PE and the S&P, I think, is over 19 now. So it's starting to be a little bit expensive. You're going to either have to have valuation expansion or a big shift in earnings to get you to your $5,000 at year-end target on the S&P 500, which I don't know. We're still a little ways away from there.
The cruise lines are going to get us there. They're going to power it all the way to the top. Well, let's segue into inflation and interest rates as we kind of move into bonds. But I thought there was a great headline in the Financial Times last month that the Swedish were blaming Beyonce for some of their bad inflation numbers. Apparently she had a concert. And so then all the hotel data, all the restaurant data, all the things they use to measure inflation were way up. And they said, oh, that's a one-time thing because Beyonce was here. I find that hard to believe. Maybe it's a small country.
She is no Taylor Swift. Taylor Swift just is going to do $1 billion. $1 billion. So
the Swifties are going to be the next wave of inflation
from her tour, and it's expected that she actually generated $4 to $5 billion just in ancillary stuff, merchandise, people coming into town to eat out at restaurants, hotel stays. I mean, she has single-handedly moved global GDP. Which is pretty amazing.
Be the first person to crack $1 billion on her worldwide tour when she starts the European leg. The previous record was in the 900s by Elton John, and she's on track to crush that number, which is wild.
I went to one of her shows; it's fantastic. I mean, I'm a Swiftie.
You went to the most recent, the Eras tour?
No, the one in Houston. Yeah, I paid a ridiculous amount for tickets.
And you got to go, huh?
I'm proud to say I added to that statistic of the $1 billion in profit.
Well, inflation is a problem here and abroad. Here it seems to be coming down a lot. Over in the UK, it's hoping to have inflation to 5.4%, so they continue to raise rates. The ECB broadly across Europe are noticing, we have a little bit of a problem. But one exception to that is Italy seeing their inflation rate come crashing down because their growth is coming crashing down. So they might be what I would consider one of the weaker economies in Europe. So if their growth is hurting and inflation is coming down from it, I would expect that Germany, the UK, France, other places that traditionally have stronger economies, they're going to roll over next. And if we keep raising rates like we have been, I would expect the US at some point to roll over as well. And we're starting to see that employment data. We're starting to see inflation data.
I agree. And I think there's two ways to look at this. There's the economy and then there's the consumer. And the economy actually does not look terrible right now based on the numbers that we've just been talking about. They're all going in the right direction. What doesn't look great that no one's really talking about is the shape of the consumer. and it's not great. There was just a CNBC headline about an hour ago about credit card debt hitting $1 trillion for the first time ever. You look at delinquencies right now in credit card debt. 30-day delinquencies are up to about 6.5%. Auto loans, 30-day delinquencies are up to about 7%. I mean, these numbers, you have to go back to 2011, 2010 to see those numbers. But it's not just the delinquencies in the credit cards and the cars. I mean, you look at auto loans. I saw an interesting stat. This is the most expensive period in the history to ever own a car. There are only 8% of new cars are priced under $30,000 right now. And for the first time ever, there is actually more auto loan applications being denied than being accepted. I think the rate is like 22%. And to take that a step further,
rate.
It's huge. And do you know at the peak, our excess savings, household savings, was 2.1 trillion during COVID. We that number is now
That was just
down.
the transfer payments, right?
That was just household excess savings, 2.1
But the
trillion.
savings was because they were just getting an extra check from
Correct.
all the various sources.
But that's now
that helped pay off those credit cards. And in the consumer's defense, wage growth has never been higher in the last few years. 4, 5, 6%. So I think a lot of people probably bought more than they could on a credit card or a car or a house in anticipation of, I'm going to get these 5, 6% wage increases every year. This is great. And now maybe wages are falling off, and I think you'll see the inflation disappear too.
Yeah, I mean, personal savings rate is down. It's the lowest since 2007 for personal savings as a percentage of disposable income. It's down to 4.3%. The average is 9%. And that's coming off of 10 and 11% numbers for the previous years. So it's a little bit concerning just to see the amount of debt that's adding up, savings go down. And I think a lot of it is due to obviously the drying up of capital and the cost to borrow right now. So it'll be really interesting to see what happens on the consumer side as we continue to go through this extremely high interest rate environment.
Yeah, talk about the cost of capital. The 10-year Treasury yield climbs to 9-month high. Mortgage rates hit a 22-year high. Meanwhile, high yield bonds, the spread between them and kind of what we consider investment grade, has shrunk to some of the lowest levels we've seen in the past few years. So spreads are getting tighter while yields are climbing higher.
Yeah, it's a concern with the yields. It's not just what the Fed has control over, which is the short end. You're now starting to see the other parts of the curve, the long end of the curve, starting to go up, and I think you're seeing it for a couple of reasons. One, the U.S. just got downgraded, so that naturally is going to have a spike in yields, which is probably one of the reasons why you've seen this small sell-off that you've seen in the last week. But also there's something called the yen carry trade, which I don't think we've ever talked about on the podcast, but it was interesting. I was reading an article by Bespoke talking about it and comparing it to the mid 2000s. And what that is you have JGBs, which is Japanese government bonds, were at zero for like ever. I mean, they just came off zero. Their 10-year bond, a year ago, they were at 25 basis points. 18 months ago, they were at zero. So you had people borrowing at zero and investing the difference in our 10-year bond, which is at 4%. So you collect the spread of 4%. Or you don't invest in our 10-year treasury, you invest in this AI boom or the stock market or real estate. And you're starting to see, you might start to see that trend unwind and that trade unwind, which is maybe why rates are jumping up on the back end of the curve, because now JGBs went from 0 to 65 basis points for the first time in like 20 years.
What we're talking about is somebody borrows a lot of money in a country with low interest rates. So for example, in this case, Japan, interest rates at 0. So you borrow for, let's say, 1%. You come over to the United States and your expected return is 7%. And you go, okay, well, I'm going to buy something that does 7. And then you make that 6 as a spread. Now, the risk with that is, well, there's a lot of risk to it. But one of the major risks is, what if the currency just becomes weaker to adjust for that? And so there's we'll call it a high finance trade with this stuff. But yeah, it's harder to do when interest rates are higher, especially if they're rising in the place you borrowed.
Yeah, and it's because the spread's so wide. We haven't seen the spread that wide in a long time where you have our 10-year government bond at over 4% and there's at almost zero. That's a big spread and there's a good enough cushion for that currency swap to your point. But yeah, there is a lot of risk, but that's where a lot of the money goes into the treasury market. It comes from overseas. And if that starts to unwind, supply starts to flood the market, bond prices are going to go down and there's an inverse correlation to interest rates. So you could see rates go up, and we know what happened when rates go up in the stock market. There's a negative correlation, at least what we saw last year. So I don't know if that trend will continue to play out, but it's something to keep an eye on.
Yeah, and to follow up on your downgrade of the U.S., the gap between U.S. and European borrowing costs hits its widest level this year. It's now 1.6% difference between the U.S. 10-year Treasury and the German bund. So not great to get downgraded. I mean, if you look at the basket of countries the U.S. is now with for credit quality, it's not great. And for debt to GDP and some other things, it would be nice if, we'll say, the politicians would address the problem. I don't have all the solutions for them, but I would agree maybe spending would be a good way to start. Maybe tighten the purse a little bit. That's where I would start from there. As far as performance for bonds for the month, pretty flat. The municipals are basically flat. U.S. bond index, the Bloomberg U.S. Ag, which is kind of a major indice. It's only about 2% for the year, but for the month, down 0.07%. So basically nothing. A little movement on the Treasury curve. You saw the 30-year get hurt, and basically flat in short rates. So nothing to happen in mortgage-backed securities, nothing in preferreds. Pretty quiet month in fixed income.
Yep. Nope. I agree.
All right, should we talk a little bit of housing and commodities?
Let's do it.
All right, so in housing, we finally saw a turn take place beginning of last year, from January 2023, which is the beginning of this year. The prior 7 months, the Case-Shiller Home Index for the national average was down 7%, and it's continued to decline. And so it looks like housing peaked and has declined primarily, I would guess, from interest rates being higher and housing prices having to come down. And again, this is national average. So if you're in a certain state or a certain city, these numbers are wildly different. And just to put in context, down 7 doesn't seem like that big of a deal, but down 10, that would matter. During the housing crash, they fell 35%. In the housing bubble, the 9 years prior to that, they rose 75%. So housing prices, I think people forget, are very volatile. They can go up a lot and they can go down a lot. I think because we've been riding this wave of just gains for quite a while since 2008, people forgot, hey, every month my house goes up in value. This is great. I keep making money every month. Well, it can go the other way, and it finally started to.
Yeah, no, and it's a big metric to keep looking at because of the core inflation number. I mean, it makes up almost 2/3 shelter, which is rent and housing costs. So that needs to come down because that's probably, in my opinion, the biggest driver of the inflation number. So hopefully it continues to move in the right direction. But to your point, I think it's based on geography. You're starting to see areas that are hit a lot more that are tech focused and doing layoffs, like the West Coast and the Northeast, versus areas like Texas, where there's a ton of job growth and you're probably not seeing a lot of movement in housing prices.
Well, to take a popular phrase from past 15 years, it might be an opportunity to buy the dip. If we were to see interest rates get cut by the Fed over the next year, I think housing prices could definitely zoom back up. And if that happens, definitely want to be a part of it, right?
Yep, I agree.
All right, should we talk a little commodities? So what's new in oil, Tom? You're down in Houston. I've heard the prices of the pump are going up. We're back in the 80s on crude oil.
Yeah, we're back in the 80s. I don't think we're going to be much. We've been trading in this range between the low 70s and call it high 80s, and I think we're gonna stay there. I mean, if you look at just the amount of global consumption versus global production, for 2023, we're supposed to have a slight surplus of 0.4%. I mean, as a globe, we produce 101 million barrels per day, and we consume about 101 million barrels per day. A lot of that coming from China, which if they start to slow down, that's going to be the big driver of demand in oil, and you saw some ugly numbers come out of China last
Yeah,
night.
deflationary, not even disinflation, but actual deflation coming out of China. That's a
Yeah,
problem.
it's usually supply driven oil. It's not usually demand's usually pretty consistent, but you could see a shift, and if supply starts to go up and demand really starts to go down, you could see a big jump in energy prices. But you know, oil stocks and the energy sector last year had such a big run. They've given up some of that this year, and again starting to make a slight rebound. So listen, I've always been in the camp. Alternative energy sources are not going to even make a dent into oil for quite some time, in my opinion. So I don't think it's going
Yeah, I
anywhere.
think.
Go ahead.
Yeah, no, our mid-month podcast, we're going to touch on the changing face of ESG and how there's a backlash against it. For some of it's just the performance of last year and those people not participating because they didn't have any oil stocks, but also because we need it and the other options are not there yet. So, the same thing is true of copper. Everybody wants copper, what it provides, but nobody wants any more copper mines. The demand for copper continues to grow. Um, any thoughts on gold or the other precious metals?
Historically, gold has been a great inflation hedge, and I just don't think it's just stuck. It cannot get above this $2,000 an ounce, and when it does, it just retests and it drops below. And we've just been trading. We've been trading in this range. I think the dollar obviously has a lot to do with it as well, and we're starting to see the dollar make a slight rebound. I mean, we hit the peak. Mid last year, and it's gone straight down. So I think the gold prices and commodities in general have a direct correlation with the dollar, our currency, which also has a correlation with interest rates. So I think portfolios should have some sort of real assets. I've always been a believer in that. Sometimes there's areas where you want to be more offensive and have larger allocations, and then there's just times where you want to just have some exposure. I think having exposure right now is more than enough, and that's whether it's gold, copper, silver, the precious metals. You know Real assets can be made up of anything. I mean, real estate, different types of energy stocks. So there's different ways to play it, but I think having commodity exposure is good.
Yeah. So the last piece is just talked about the U.S. dollar. That correlation was really strong in 2022. If the dollar was going up, stocks were going down. If the dollar was going down, stocks were going up. And we saw a little bit of that happen in July, where the first 2 weeks the dollar had a terrible performance. The first week it was down 0.5%, then down 2%, and then around mid-July it started flipping and going the other way. And you could see almost a perfect opposite performance from the U.S. Equity markets. As the dollar goes up, the equity markets go down, and vice versa. So, if the Fed stops raising rates, maybe the dollar gets weaker. If they continue to raise rates, I could see it getting stronger, obviously depending on what other central banks do as well. But I think that's really, we almost buried the lead for maybe why July was such a good month for equities, is the dollar was down slightly.
Yeah, yeah, and so far to start this month, it's been kind of the opposite. So I agree with you. I think the Fed needs to continue to stop raising rates, which the market has that priced in. We'll see if they continue to go again, but if they stop and then eventually start to cut next year, I think you'll see the dollar follow accordingly.
All right, Tom, for a final segment today, we're going to do, we don't even call it education. We just call it 5 good minutes. And this week, we're going to talk about, you had a better word for it. I'm going to call it municipal bonds. What do you want to title this segment?
Let's call it tax efficient income strategies.
All right, I love it.
With
So the focus that I'd like to start on that is, we'll talk about MLPs and some other things another time, but for today, the biggest one is just municipal bonds. So for those who've ignored this asset class like everyone else for 15 years and only really bought stocks, municipal bonds are typically tax-free. They're issued by state governments, by cities, by utilities, by water districts. There's various levels of quality. Detroit is the only city that comes to the top of my mind that's defaulted relatively recently. Overall, the default rate on municipal bonds is about 0.5%, so a very low rate of that. The yields tend to be very low. So if you're going to go out just for the first few years and you're looking at, high quality rated, so AA and higher, not basically where the U.S. government just got downgraded to. You're only going to get about 2.25%, maybe 2.5% for those first few years. And so one of the things you have to know about municipal bonds is that they are tax free. And so you have to do a quick calculation to see what that yield is, and that's called tax equivalent yield. Would you like to jump in here, or you want me to keep going?
Yeah, and just a couple comments. One, municipals is a unique asset class because it's 100% retail driven, meaning corporations aren't buying municipal bonds because they don't need the tax-free income. It's mostly for individuals like yourselves, high net worth, or just retired looking for tax efficient strategies. So to your point, when you look at the municipal market right now, yields typically are lower because they're tax free, but you have the spread right now is the widest it's been between taxable and tax free. So there's what's called a muni tax equivalent, meaning if you take the same duration, so let's take the 30-year treasury at 4%, the tax equivalent muni is trading at 6% right now. Meaning you're getting about 3.5% on a municipal bond versus 4% on a treasury. And if you factor in taxes, that 3.5% is really closer to 6 if you're in the highest tax bracket. So that spread has never been wider.
Yeah, the government bonds. So like the U.S. Treasury, for example, you can look at the after tax, what that yield would be. And so today, let's say that it's 3. Well, when you're going to get taxed on that at a 40% rate at your top tier, you're only going to get to keep 2/3 of that, 60% of that or so. So then you're really looking at, okay, it's a 2%. So even though these yields for high quality municipals, they seem low, they're actually a lot higher. And the best example is those high tax states. So if you live in New York City, you have state tax, you have city tax, and you have federal tax. So if you add all those together, your tax rate is 55.6%. So if you were to do a municipal bond and you were to buy it, and let's say it yielded 3.5%, your tax equivalent yield would be 7.88%, which means that you'd have to buy some of the worst high yield companies out there to get that kind of return. And instead, you can buy some pretty high quality AA rated municipal bonds.
Yeah, and one of the biggest risks with just bonds in general is obviously interest rate movement, but is default risk. And if you look at municipal bonds versus corporate bonds, so not treasuries, but versus corporate, defaulting over the last 10 years, there's different tranches you have from credit quality, from AAA all the way down to CCC. In every single tranche, you had a lower default rate in municipals versus their respective corporates. Also, when you look at municipal bonds versus, say, government bonds, I mean, you look at state and local debt right now as a percentage of GDP, it's low. It's about 14.5%, 15% versus.
Well, you know why that is, though, right?
Our government debt at 97 versus GDP.
The states and the cities have to have a balanced budget. They have to. They're legally required to, versus the federal government doesn't. And so they're at 122% of GDP because they can be.
Right. Yep.
The cities and states, they have to pay all their bills every year. And so they don't have the choice to go, oh, we're just going to run a deficit. No, there's no deficit.
And I mean, municipal bonds are great too, because a lot of them are revenue driven, toll roads or, sewer bonds or whatever they may be. Obviously there's risks in any asset class, but right now, to your point, because of where yields are, the tax equivalent yield is very, very attractive in municipals. And I think it's a great place to be, as opposed to just sitting in a money market or a CD that's taxed very differently.
Yeah, so the couple things risk-wise to make sure we address is interest rates. So if interest rates rise and you own a municipal bond that doesn't mature for 20 years, the value of that bond is going to go down. If you just keep that individual issue, so not in a fund or in an ETF, and you hold it to maturity, it will mature at par. But in the interim, you're going to see a much lower price on your bond. The other thing to consider is that quality matters a lot. So if you're going to go buy some of these cities that we know are not that well run, that recently got bailed out after the midterm elections, they got a lot of money and kind of fixed their balance sheet that way. I would focus on high quality. So you can look at some general allegation for high qualities, whether it's a school district or a city, but you can also look at revenue, sewer and water debt when they go build out the utility companies, that infrastructure. That can be really high quality. I mean, what's the old joke? I think Warren Buffett goes, what's the perfect investment? It's a toll road where it's already completely built and it never has to have any maintenance, and you can just charge higher tolls. they build out these toll road authorities. So it's a good situation from a credit quality, and there's always ratings done on them. So you can find these by, Fitch, Moody's, other places do these ratings, and you can see, okay, where do you want to take a risk? And so I think that at least single A, but probably double A and higher is pretty high quality. And then the last piece is just liquidity. Because these are individual issues, if you wanted to go and sell them, there's not always a market. Now, most of the time there is, but there's been a couple examples I can think of. I mean, March of 2020 is a great one where there was no action. There was no bids to go buy these. So you were then stuck with them and the cash flows that go with them. So there is some of that risk. So as far as sizing in the portfolio, you want to keep some emergency funds and other things in more cash like a money market or T-bills. But if you want to go out and say, okay, I'm going to take a portion of my portfolio, get tax-free income off, and borrow 15, 20 years out, high quality munis and making 6% on a tax equivalent basis is pretty attractive.
Yeah, no, it's a good point. I mean, I have a lot of clients asking about CDs, and I know you do as well, Kevin. And you just have to remember the yield and the income you're getting on a CD is taxed very differently than on a municipal. So you have to factor that in. And the higher your taxable bracket is, the more typically, generally speaking, municipals would make sense because, again, of that tax equivalent yield.
You could have just not want to pay taxes, right? So even if you're on a lower tax bracket, let's say you're 28% or 22% tax bracket, you're like, I don't want to pay at this level. It doesn't have the same bang for the buck, but you're still going to get, a 3.5, maybe it becomes out to 4.5 or 5%. It's something that's worthwhile when I just don't want to pay any more taxes. So in Texas, it's great because all your state income is exempt because there is no state income tax. In other states like California, New York, you do have to typically buy their state's bonds. So it can still be some of their toll roads for revenue bonds and other things, but each state has different rules. So make sure you work with a good CPA and figure out what yours are before you just dive in and find out, wait, but I bought these California bonds, but I live in New York. That's not exempt from interest. Not for state income tax, it's not. So it's something to make sure you're buying the right ones and working with a good financial advisor and a CPA, having your whole team together and evaluating all those risks. It's a really powerful vehicle.
Yeah, no, there's 3 buckets. There's ordinary income, there's capital gains, and then there's tax free. So you want to have a good mix, and everyone's different. So, well, what else you got, Kevin?
Well, I would just say that, as far as the yield curve in municipals, it actually is more favorable. It's more normal. So if you're wanting to borrow for 5 years, those rates are lower than if you're going to lend out for 15 years or 20 years, as opposed to in the U.S. Treasury market right now, you can get a higher rate on 6-month and 1 year than you can on 10-year and 30-year. So it doesn't make sense. It's inverted. So I think that this asset class is something that many people have ignored for a while, and it's something to learn about again. And as you mentioned, it's dominated by retail. There's a lot of different funds that buy these as well, but I think that it's a good fit for most people. And as far as sizing,
I agree.
We always consider diversification. Don't buy all of it in one issue, right? Spread it out between different states or different municipalities. Don't just buy your local city and, oh no, the city went bankrupt and now you have a new problem. So diversify in municipal bonds matters as well.
Kevin, what would you do? How would you feel if you were playing in the World Cup for the USA and the whole entire country hated you? Would you have missed that penalty kick too?
They didn't miss one; they missed 3. And 2 of them were air balls. One hit the post, and then here's the other wild one. It was the Swedish one, or it was Sweden, right? So the goalkeeper for the U.S. actually makes the block, which the play's over, right? No, it somehow has the English where it spins and goes back into the net. So I don't know. The game came on at 4 a.m. I didn't watch. I saw some of the highlights, and I think we're all disappointed that it didn't go well, but.
I've never seen so many bars and so many people in all parts of the country, by the way, cheering for the U.S. to lose. It's really in a bad shape as a country. But anyway, I digress.
Yeah, well, I think if you start to wade into politics, it's a tough business because politics divides people. And so when you do that, you're going to make, at least in this country right now, half the people mad and half the people love you. And so both sides are going to be very loud when you upset them. So
that's true.
That's a case for, what is it? Stick to sports. We tell the radio show people, like, you don't have to, but if you wade into it, you're going to have a lot of blowback. And I think that some of the members of the team chose to wade into a political venue, and comes with consequences and trade-offs, just like any good economist would tell you.
Yep. Nope. I agree. All right. Well, we'll end it there, and then we'll kick it back in 2 weeks with our mid-month podcast.
All right. Thanks, Tom.
All right.
You've been listening to Your Money Momentum, brought to you by Global Wealth Advisors. To learn more about GWA and its talented roster of financial professionals, head on over to gwadvisors.net. Thanks, and we'll see you next time on Your Money Momentum. All indices are unmanaged and investors cannot invest directly into an index. Certain sections of this commentary contain forward-looking statements that are based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties, which are difficult to predict. Past performance is not indicative of future results. Diversification does not assure profit or protect against loss in declining markets.